All right, welcome. Today, we are stepping right into the ring for one of the biggest, longest-running rivalries in the entire world of finance. It's a true clash of titans, a battle of completely different philosophies, growth versus value.
Okay, let's get right into it. And look, this isn't just about some dry financial theory. We're talking about a high-stakes showdown between two fundamentally different ways of seeing the market and, deciding where to actually put your hard-earned money.
So, in one corner, you've got team growth. These are the high flyers, right? The innovators, the companies making huge bets on what the future is going to look like. And in the other corner, you have team value. Think of them as the savvy treasure hunters, always searching for those solid, undiscovered gems that the rest of the market has kind of overlooked.
So let's really meet these contenders and break down what's in their playbooks. What is it that actually makes a stock a growth stock or a value stock?
Growth investing. It's all about one thing: future potential. Investors here are looking for companies that are just on an absolute tear, set for rapid expansion. They're totally willing to pay a premium price today because they believe that company is going to be way, way bigger tomorrow. Value investing, on the other hand, is all about finding a fantastic deal. It's almost like being a detective, you know? You're digging around looking for these fundamentally strong companies whose real underlying worth, what we call their intrinsic value, is actually higher than what the stock market is saying it is. The whole goal is to buy a dollar's worth of a great business for, say, 50 cents.
And when you see them side by side like this, the differences really pop. Growth investors are laser-focused on future potential, so they're cool with paying a higher price compared to what the company earns right now. That's a higher PE ratio. Value investors, they're all about current worth. They're hunting for companies with rock-solid fundamentals that are trading at a discount, so a lower PE ratio. See? Two totally different paths, both aiming for profit.
So we've got our two very distinct styles. And the natural question is, okay, so which one's better? Well, the answer isn't some simple knockout punch. It's actually a lot more dynamic than that. The best way to think about it is like a seesaw.
So let's just ask the question directly. After all is said and done in this epic clash between growth and value, who actually wins? And here's the twist. There is no single winner. It's a trick question. Neither one of these styles stays on top for good. Instead, their performance moves in these really powerful long-term cycles.
We call this style rotation. You see, for years at a time, growth stocks might be the undisputed market leaders, just fueled by all this innovation and optimism. But then, as the economy changes, the market transitions, and suddenly those solid, dependable value stocks take the lead. It's a never-ending cycle of leadership, back and forth, back and forth.
But why? Why does this even happen? What's the invisible force pushing that seesaw up and down? Well, the answer is found in the wider economic environment. And here are those economic drivers. See, an economy with low interest rates and tons of optimism, well, that's the perfect rocket fuel for growth stocks. Investors are just more willing to take bigger risks on the future. But when interest rates start to climb or uncertainty creeps into the market, investor psychology flips. People tend to get more defensive, and they start looking for the safety they perceive in value stocks, with their solid books and bargain prices.
Okay, so now that we get the theory behind this whole cycle, how can we actually use this knowledge? This brings us to the really practical part of our explainer, your winning strategy.
Now, you might be tempted to try and jump from growth to value right before the market turns. I get it. But honestly, the data is pretty clear on this. Trying to perfectly time these cycles is incredibly difficult, even for the top professionals. A much, much smarter approach is to just have a solid playbook that's going to work no matter what the environment looks like.
And here is that playbook. It's pretty straightforward. Step 1, diversify. It's smart to own a bit of both growth and value to spread out your risk. Step 2, keep an eye on the economic environment. Not so you can predict it, nobody can, but so you can understand how it might affect your investments. And step 3, and this is probably the most critical one, always focus on the quality of the individual companies themselves, no matter which style box they happen to fit into.
At the end of the day, the goal isn't to pick a side and declare your loyalty to team growth or team value forever. The real winner is the informed investor, the person who understands both playbooks and knows how to navigate the game as the conditions on the field change.
So I'll just leave you with this final thought. Based on everything we've just covered, take a look at the world around you on January 15th, 2026. What's happening with interest rates? Is investor sentiment feeling optimistic or a little more cautious? Which side of this great big seesaw do you think has the momentum right now?